Welcome and thanks for downloading this 1031 exchange tutorial. Let's spend a few minutes covering the basics of tax-deferred exchanging, shall we? You're probably here because you're interested in selling a property and replacing it with another property or properties, and you'd like to accomplish that on a tax-deferred basis. So, let's start by covering the basics of 1031 exchanging and finish up by identifying a few pitfalls which experienced exchangers always avoid. First off, tax-deferred exchanging is not a new concept. In fact, it has been in the Internal Revenue Code for almost 100 years. The rules for completing a compliant exchange are now found in Internal Revenue Code section 1031. Now, if you wandered over and started reading section 1031, you'll notice that one of the first requirements is that you must use a QI, or qualified intermediary. And this is usually a well-established company whose sole job is to coordinate your paperwork and to hold your exchange funds in trust as you sell certain assets and replace them. Selecting your qualified intermediary is very important. In fact, it is so important that we simply encourage you to use the biggest and most established intermediary in the country, IPX 1031. We found them to be amongst the very best in the business. Now, any exchange has to include what are known as like-kind properties. And for the purposes of 1031, like-kind means property held either for investment or property held for income. So this is investment property we're talking about, not your personal residence. Next is this. You have a total of 180 days to complete your exchange. Now that also means that if you start your exchange late in the year, you may have to file an extension in your tax return in order to get all 180 days before your return is due in April. Now how about identification? Because it is usually considered one of the most important 1031 requirements. Bottom line, you must identify within 45 days of your sale, and whatever you buy must be something you've previously identified. Now here's a caveat about identification. It is important, but it's not difficult. So if you have any questions about it, just call us or drop us an email. Here's the first identification rule, the 3-property rule, meaning, of course, that you can identify up to 3 properties of any value. Next, we have the 200% rule, meaning you can identify more than 3 properties, but when you do, whatever you identify in total value cannot exceed more than 200% of what you sold. And now the 95% exception. It is basically this. You can identify more than 3 properties, and you can identify more than 200%, provided you buy at least 95% of the property's value that you've identified. Almost like the 100% exception, isn't it? So now that we've covered the rules, what do you think the big 3 pitfalls might be? First pitfall, make sure your exchange funds, while they are on deposit with your intermediary, are safe. That may seem obvious, but nevertheless, make sure your QI knows what they were doing and can ensure your funds are handled appropriately. Once again, this is why we refer folks to IPX 1031. They are big and they are safe. How about pitfall number 2? Well, your 45-day ID period moves especially fast, so make sure you start looking for replacement property as early as possible. In fact, looking before you close on your relinquished or exchange property isn't a bad idea. Pitfall number 3, plan your exchange first. There are just too many moving parts and property transfers happening not to think it all through completely before you start. And we will help you do that, and we'll make it all painless. Often we're asked, is there an easy way to look at or approach the financial aspects of a 1031 exchange? And the answer is yes, and it is this. If you want a totally tax-free transaction, you need to do these 3 things. First, buy a replacement property which is equal or greater in value than the relinquished property you're selling. Number 2, Move all your equity from your old property into the new property. And lastly, number 3, replace your debt. If you do those 3 things, you should have a tax-free transaction. And to the extent that you don't do those 3 things, to the extent that you trade down in value, hold back some of your cash, or don't replace all of your debt, you're likely going to owe some tax. That's the quick math of 1031. So, those are the basics of 1031 exchanging. If you have any questions, don't hesitate to give us a call, and thanks for your time.